At 9:30 on a Wednesday morning, the New York Stock Exchange opened as usual. Knight Capital was one of the biggest trading firms in America. Its computers were buying and selling shares for customers across the country. Everything looked normal. 45 minutes later, those same computers had traded almost 400 million shares that Knight never wanted. The company had lost more than $460 million. That is roughly $10 million every minute. And here is the strange part. There was no hacker, no rogue trader. No one had typed in a $1 billion order by mistake. Knight was being attacked by its own trading system. And the first warning had arrived almost 90 minutes before the market even opened. Knight Capital was not some small company experimenting with a new technology. Its trading activity represented roughly 10% of all trading in listed American stocks. So, this was a serious part of the financial system. Every day, customers sent orders to Knight. Knight's computers then found places in the market where those orders could be filled. And they did it extremely fast. That speed was the whole point. In the summer of 2012, the New York Stock Exchange was preparing to launch a new program for retail trading. Knight wanted to take part. To do that, its technicians had to update a high-speed order router called SMARS. Nothing unusual, just new code for a new market program. The update had to be copied onto 8 servers. Well, 7 of them received it. Beginning on July 27th, a technician installed the new software server by server. But the code was never copied onto the 8th machine. There was no second technician checking the work, no automatic tool confirming that all 8 servers were running the same version, and no written procedure that required either of those things. So when the deployment was finished, 7 servers were ready for the new program. The 8th was not. Now, that alone should have caused a small technical problem, maybe some rejected orders, maybe a short delay, but the 8th server was still holding something else, an old piece of software called PowerPeg. Knight had stopped using it back in 2003, but instead of removing it completely, the company had left it inside the live trading system. For 9 years, it had done nothing. Then somebody reused the switch that once activated it. At 8:01 that morning, Knight's internal systems began sending emails. The messages referenced the SMARS router and contained the words "PowerPeg disabled." Then another email arrived, and another. By the time the market opened, Knight employees had received 97 of them. Now, to be fair, these messages had not been designed as emergency alarms. There was no red light, no siren. They looked more like normal technical rejection messages, and employees generally did not review them as they arrived. Still, they were telling Knight that something inside the new deployment was not right. The system was whispering before it screamed. But nobody investigated the messages before 9:30. And then, the market opened. The first customer orders entered SMARS. 7 servers handled them correctly, but when an order reached server number 8, the new instruction did not activate the new program. It woke up PowerPeg. To understand what happened next, imagine that a customer wants to buy 100 shares. The router may divide that request into smaller orders. It keeps sending them until all 100 shares have been purchased. Then it stops. Simple. PowerPeg had once been able to count how many shares were already filled. But in 2005, Knight had moved that counting function to a different part of the software. Nobody retested PowerPeg afterward because, nobody expected to use it again. So when the old code suddenly came back to life in 2012, it could still send orders. It just could not understand when the customer's request was complete. It sent an order. The market filled it. Then it sent another, and another, and another. The original customer might want only a few hundred shares. The server did not care. As far as PowerPack understood, the job was never finished. So, inside Knight, one account began collecting strange positions. Stocks the company had not meant to buy. Stocks it had not meant to sell. Senior employees could see that something was badly wrong, but their monitoring system was exactly that, a monitoring system. It could not show the damage. It could not stop the orders. One account involved in the incident had a gross position limit of $2 million. That sounds useful, right? But the limit was not connected to an automatic control capable of shutting down the trading system. It was basically a number on a screen. And during heavy trading, that screen could also become delayed and inaccurate. So while employees tried to understand what was happening, SMARS remained connected to the markets. The orders kept going out. Then Knight tried to fix the problem, and somehow the fix made it worse. Because the technicians suspected the new software, so they removed it from the 7 servers where it had been installed correctly. Normally, rolling back an update sounds reasonable, but remember what the new code had replaced: PowerPack. By removing the working update, Knight allowed the same old function to be triggered on more servers. The problem that had started on one machine could now spread. I mean, imagine realizing that one server is running wild, and then accidentally waking the same broken code on the other 7. Knight still had no effective automatic kill switch, no firm-wide control that looked at the growing exposure and simply said, "Enough! Stop trading!" The company was debugging a live system while that system was spending billions of dollars in the real market. The runaway trading continued for about 45 minutes. Only 212 customers' orders had triggered the defective code. But SMARS sent millions of child orders and produced more than 4 million executions across 154 different stocks. Knight traded more than 397 million shares. It accidentally built a long position of about $3.5 billion in 80 stocks. At the same time, it built a short position of roughly $3.15 billion in another 74. And the orders were large enough to move the market. In 37 stocks, Knight made up more than half of all trading, while prices moved by more than 10%. By the time the orders finally stopped, Knight was holding billions of dollars in positions it did not want. Those positions had to be closed. The final loss was more than $460 million. The software problem was over. Now Knight had a different problem. It needed money, fast. The loss had damaged its capital and shaken the confidence of customers and other financial firms. Without immediate help, Knight said the crisis threatened its ability to keep operating. 5 days after the incident, a group of Wall Street investors provided $400 million in emergency financing. But the rescue came at a heavy price. The preferred shares issued to those investors could convert into roughly 73% of Knight's common stock. So yeah, the company survived, but it was no longer the same company that had entered the market on Wednesday morning. Less than a year later, Knight combined with another trading firm, GETCO, under a new company. It is easy to blame this disaster on one technician who missed one server. But that explanation is too comfortable. People, they miss steps. People misunderstand warnings. People make mistakes. A safe system is supposed to expect that. Knight's system did not. One deployment error passed through every layer behind it. Old code was still waiting on live servers. The warning messages looked ordinary, The risk monitor could see the damage but could not stop it, and the emergency response activated the problem on even more machines. On Wall Street, speed is supposed to be an advantage. That morning, speed did something else. It took every small weakness inside Night and made them all arrive at once. Thank you for watching, and if you want to trace more failures back to the moment they first became possible, subscribe to Failure Atlas. And now you choose our next point on the map. Which failure should we investigate next?